The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, folks, welcome back to the Diagnostic Trading Hour. Hope y'all are having a great trading day out there. And pretty flat across the board. And if you have any questions, by the way, if you want to call me up, just give me a call. The number is always right there on TFNN.com. Also, go ahead and give it to you right now. You can give me a call at 877-927-6648 with any questions that you have. Again, that's 877-927-6648. And go ahead and do a quick market wrap, looking at where everything's at for you. We got the S&P up, not even a point, up 0.75 right now. We got the NASDAQ up 2.75. The Russell up 3 points. And we got the Dow up 4. So, I mean, literally just a flat market. And we also got a natural gas. It's moving down quite a bit. It's down 1% for the day. It's been dropping quite a bit lately. We got oil actually up, a little bit, 61 cents on the day so far. And we also have silver is coming back down off that surge that it had. And we got gold down 4 points. And we also have copper is down 0.40%. And we got, let's see here. Let's look over here at the soybeans. We got soybeans up 7.5. We got corn flat. And we have, looking at the currencies, we got the bond. Let's see, the bonds are up a little bit, but the currencies right now, we got the pound dollar up 0.29, the euro dollar up 70 pips. And we got the Aussie dollar up 15 pips. Looking over at the yen, we got the euro yen up 0.21 pips there. We got a pound yen up 18, and we got the U.S. yen down, or actually down 18 on the pound yen and down 22 on the U.S. yen. So, just some flat market. Why? Well, because it's Fed funds, season, right? So, what is ECB going to do? What is the German Constitutional Court going to do? What is Bernanke going to say on Friday? What is the Fed funds rate going to be next week? And nobody's willing to place any big bets. So everybody's sort of waiting to see what has happened. They've sort of priced in a QE, but most reports are starting to come out saying that they don't think it's going to happen. I don't think it's going to happen unless there's some really bad ruling out of the German Constitutional Court that just rocks the market and they think they have to as a justification to, save everything. I don't see QE3 happening here next week. I think all we're going to see, or in 2 weeks here, and that's going to be announced on September 13th. And I think what we're going to see is they're going to just extend out the outlook on keeping interest rates low for yet another year. So, I mean, we're talking all the way up to, 2015 now. And, it's really interesting. I mean, they're doing that to try to ease credit flows and all that stuff. But in reality, banks aren't loaning more money. So it's not really having a huge impact. As far as extending the credit rate, because credit is not interest rates are not the problem. The problem is banks don't want to loan it because banks are unsure about the economy because of all the global things that are going on and just the regulatory actions that are crazy out there right now. And so they're slow to loan and businesses are slow to hire, and until governments get out of the way and let private sector businesses do their thing, that's not going to change. And so a lot of them are starting to actually say, it's time just to get off the Fed funds QE. Whatever, and there's, several words for that, but just to, basically stop taking that and just let the market start standing on its own 2 feet. And, it may fall down, but, it can also bounce right back up, and it always has been resilient before, but it cannot walk on its own 2 feet if it thinks there's going to be constant interference. And so, hopefully the Fed will get out of the way, and the other ones will, just pick what they're going to do and do it. And quit dragging it on. And I know they're trying to make it as slow as possible to give the economy time to recover. That's the whole theory behind what's going on right now is if we do QE and if we keep rates low and if we keep doing these bailouts, then eventually that'll become the norm. And then people will get confidence that that's the norm. And then they'll start doing all their thing. And then when we pull it out, the true economy is standing on its own 2 feet. So it just stumbles a little bit and it keeps moving. The problem is the norm is still unknown. So with the constant unknown factor, I don't care if they do this for 5 years, it's still unknown. And so tomorrow it could totally change if they pull that out. And so people are never going to be, just fully in if they can't get some confidence about what's going to happen tomorrow as far as governments being consistent. And, it used to be the fundamentals of companies, right? Were the big driving factors. And now it's like, well, I'm glad that company's doing well, but all in all, it doesn't matter because great company doing well with a Europe falling is going to equal just global economic issues and going to take everything down with it. So hopefully we'll see that, but we got the big speech coming up, and there's some more stuff coming up as well. I'll talk to you about that a little bit later here in the show. And just looking at the that sort of wraps up the market summary for the day, and we'll go ahead and we'll look at the fundamentals. So let's check out the fundamentals, see what's going on today. And the franc actually came in, or basically Switzerland came in a little bit higher on their unemployment or their employment level, which is good for them. And we'll go over at the CB Consumer Confidence Report that came out a little lower than expected. Didn't really have much of an impact. So I mean, you can see right here, came out and it went up down like a point. So, and even being lower than expected came out, and the market actually moved up a little bit off that. So, it's sort of interesting that the market's really just not responding even to, weakening consumer confidence. So I think it's just known that there's low consumer confidence, and once they realize the fact that the QE is not coming in, then expect a lot of these gains that are built in based on that to go out because, earnings season's over, and it won't pick back up until, late September, early October. And, then we're going to have the troika to deal with in between now and then as well. And, so there's a lot of factors. This next month is just going to be insane. So the next 30 days, a lot of government stuff coming out. And if we go over and we look at, what do we have coming up for the rest of the week that you need to be aware of in your trading, because you always want to be aware of things that are coming up, government market, especially now more than ever, is we're going to have, tomorrow there is going to be several announcements. We've got the German CPI coming out. That shouldn't, rock the market too much either way, unless it's just dramatically different. And but that's, that's sort of something that comes out throughout the day. So it's not necessarily just a, boom timed number. For the United States, the big numbers are going to be tomorrow. It's going to be the preliminary GDP and pending home sales. So of course we'll also have crude inventory reports and beige book and some other things like that. But the big announcements are going to be in the morning, again 7:30 Central, 8:30 Eastern. It's preliminary GDP. And basically, this is quarter-over-quarter data, and it's reported like annualized. So they look at the last 4 quarters. All right, so basically it changes every quarter. And the previous listed number will be updated because it's historical based on the last 4. And the advanced is basically, it comes out, it has really the most impact because it's the earliest release on GDP. Okay, so out of all the GDP announcements, the advanced GDP actually usually has the largest impact. So you want to be aware that could have a definite impact on the market. If we continue to see weakening GDP, that could factor into a possible QE decision. Of course, employment claims next week are also going to be a big, the non-farm payroll, all that next Friday. That's going to be a big thing on the non-farm employment and the employment change number as far as, like what the verbiage that the Fed's going to use for QE. So this is one of the big numbers, like I said, that's 7:30 Central, 8:30 Eastern. To keep that on your rosters there because that is going to have an impact on the market. We should see some decent move off of that. And like I said, today there really wasn't a whole lot to make a big move. We had the consumer confidence, but GDP obviously is a lot more important number than just 5,000 people's opinions versus here's the economical facts on GDP and putting all that together. And then 9 a.m. of course another big factor in any kind of economic recovery is home sales. So pending home sales is going to be coming out, and that'll come out at 9 a.m. Central, 10 o'clock Eastern time, and it's released, like a week later than existing home sales. But existing home sales is ones that have happened. Okay, pending home sales is ones that are looking to happen over the next several weeks. So it's more of a forward impact, and so it can have a bigger, obviously that can have an impact on existing home sales coming up. So instead of being like a lagging fundamental indicator, it's a leading fundamental indicator. Just like preliminary GDP being the earliest one is a leading indicator. So we've got 2 big leading indicators, 2 that are very important to the state of the economy and its health that are coming out tomorrow. And again, that's 7:30 for Central, 8:30 Eastern for preliminary GDP, and 9 Central, 10 o'clock Eastern for pending home sales. That's going to be our Wednesday big announcements. There'll be some Aussie announcements coming out as well if you're trading those, and they come out at 8:30 tomorrow night. So you can check those out. That's the building approvals and private capital expenditure and things like that. Now, if we go over on Thursday, we are going to have an Italian 10-year bond auction. Obviously, that is going to have an impact just because everybody's looking at Italy, even though the fact is Italy's private and public bonds are better than Germany's when you combine them all together, which is, like I said, not discussed. Talked about this yesterday, not even mentioned really out there. So they're in better debt condition than Germany is, except for Germany, of course, is making more money. So it's one of those things. You can have more debt if you're making more money, so I understand that balance. But it's just one of those little-known facts that really isn't publicized. But that'll come out Thursday, so be aware of that. That's going to be going out, the overnight session there during the German or European market session. And so that'll obviously we'll wake up to the impact that has, if any, depending upon if it comes right in at expectations below or, greatly above if yields spike at all. I don't see a yield spiking at the moment just because there's no, big new announcements coming out. On unemployment claims, if we go over and look at those, that's going to come out 7:30 Central, 8:30 Eastern on Thursday morning. And on unemployment claims, basically, it's the earliest economic indicator on unemployment. So therefore, it's one of those things that it's claims, and a lot of times people look at it as forward, but really it's more of a lagging indicator because it's people that have filed, unemployment claims. And now it's basically covering, a week, the previous week. So on Thursday, that's going to cover last Monday through Friday on unemployment claims. And sometimes that number looks good and bad. The big thing on this is sometimes you'll see a good or a decent unemployment number, the market will drop. And people always, that doesn't make any sense. Well, the problem is you have to go and you have to look at, did they revise, okay? Did they revise previous unemployment claim numbers, and so they go in and they do all these revisions all the time as they get more data in and more detail. And so if you're ever looking for that and you want to get the latest release, you just go to DOL.gov. And you can get the unemployment claims release right there at DOL.gov. That's where they're putting all that stuff out. They talk about the seasonally adjusted data and the unadjusted data, and they go into initial claims and, insurance unemployment and, federal employees and all sorts of stuff, laying out the details. So it is sort of interesting if you want to dive into the details of the announcement. I personally just like watching the charts and looking at the final number, and then if I don't see it doing what it's going to do, then I go look at the report. Like if it's bad and the market's going up, then I go look at the report to see what was off on that. So, it's like if something doesn't make sense, I need to look at the report. If it does make sense, then whatever. Who cares about the details? And while I'm trading, I'll go back and review it later in the day. And then going over and looking at Friday, we're going to have Canadian GDP is going to come out at 7:30 in the morning. So that'll have a bit of an impact, But the big announcement, of course, is going to be Mr. Bernanke. So talking again. And man's always talking, always got something to say, and everybody seems to listen for clues, and the man doesn't like to give clues. So if he does want to give a clue, it's because he wants to give a clue to, do a little spike in the market. And so, with election season coming up, I see him being more and more and more reserved, I think, as we've seen, recently. But he's going to be delivering his speech on monetary policy since the crisis. So it'll be an interesting speech to see how that comes out. And that'll be at 9 o'clock Eastern. You can watch it live even on C-SPAN. But we'll keep you updated, of course, right here on TFNN on the important points. You're not listening to all the boring points. Hold on right there. We'll be right back after the commercial break.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her small cap roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kate Stalter, David White, Larry Pesavento, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, folks, welcome back here to the Diagnostic Trading Hour. And one of the things we left off on, we were talking about the up-and-coming ECB announcements also, with the big thing being the Jackson Hole Symposium that's starting this Thursday with Bernanke to speak on Friday. And, some interesting things that have developed on that, if you haven't already caught the news on it, is that Draghi is ditching. So he's going to play hooky. And he obviously is one of the big expectations for that to be in there. So, and he was actually going to go in, and he was going to be speaking. And again, that's Mario Draghi. And he's going to go in, he's the president of the European Central Bank. So obviously a very important person. And this symposium, just so you know, it's scheduled out every year, okay? And it has all of the Federal Reserve Bank people. It has all the big economists, the central bankers from all over the world. Like, it is the banking event of the year, okay? And if anybody is expected to attend, it's him. And he had this big key speech planned for Saturday. And he's ditching because he has more pressing matters at home than he needs to take care of, versus figure out how to work with all the other, people in the world to figure out how to, unite and come together to fix this problem. And really what it comes down to is he doesn't have more important things to take care of. He wanted to say as little as possible because he knows that there's not a lot he can do. There's going to be a big ECB press conference on September 6th, and talk about a loaded day for news. That day, like if you look at September 6th, there's so much coming out on that one day. It's going to just be a whirlwind anyway. But you're going to have low trading volume because it's just the week that it is. But people just starting to come back into trading. But you're going to have a Spanish 10-year bond. You're going to have a French 10-year bond. You're also going to have like the minimum bid rate on the euro. So basically their equivalent. of the interest rate on there, and you're going to also have the ADP non-farm employment change report. You're going to have the ECB press conference. You're going to have unemployment claims. You're going to have ISM, and that's one day. So he's waiting to speak until that day. So I guess it can be muddled in the midst of a whole bunch of other news. But he is not talking. So he's just going to take care of matters at home because he's done such a good job of that already. And so that's just really interesting that he's ditching basically the most the biggest conference for central bankers to go to every year. And there's all sorts of G20 and everything else meetings, but that's the main one. And so he basically doesn't want the market reacting until at least the 6th. And then, of course, what they're trying to do is delay everything out as far as possible to get that German Constitutional Court ruling done. And then they're trying to divert it out as far as possible to get the Troika ruling done. So that way they can, my guess is, push for a Greek exit. And they'll call it a temporary Greek exit, which means 20 to 30 to 40 years. So I don't know how temporary that is, considering it's 4 times as long as basically the EU has been alive. But anyway, so they'll just try to soft blow it, and I think they're putting it off, and they're going to let some things get rattled up, and then they're going to blame Greece, and then they're going to kick Greece out, and but say it's temporary, and to try to give some confidence that hey, we will kick somebody out if they're not doing their thing. But of course, then you have Greek default, and if Greece can be kicked out, then so can Spain, and so can Italy. So Finland, of course, is already looking at leaving, and Germany could go. You know what? I mean, if they're all gone, then great. But if they're not, then do we want to be here? And they don't want to be first. So the big game is who's going to be first to leave. And I don't think it's if. I think it's who. Who is going to be first to leave. So it's not an if somebody's leaving. And like I said, I think one of the first, it's either going to be Greece or Finland are going to be the first. But and then that'll spill off on other smaller countries going, you know what, we don't really need this. And it all depends upon how big their economy is dependent upon Europe. Finland is not really dependent on Europe for its economy. So it's the most likely one to voluntarily leave. And, so anyway, just keep those things in mind. And checking out over here, we got several things coming up I want to go into. One of the things we like to talk about is implied deviation levels on several of the markets. And so we can go in and, today, obviously not a whole lot of activity. And but we can check them out either way. And it looks like right here, the largest move down, let's see, would be a 1394. And what I'll do is I'll go ahead and give you the half deviation levels, because that can be, basically just more helpful. And with basically the reason that's helpful is when you have a flat day, when things just aren't moving, and when you have an expectation of a flat day, because you have things going on that, like we've seen today, where, everybody's waiting on the big news to come out, then a 50% deviation level can just be a lot more helpful for you. And I'm not talking about standard deviation that's historical, okay? I'm talking about implied deviation that's forward-looking, that takes into account the impact of options in the market and how far they think the market's going to move. And that gives you just a lot more accurate number to be able to base things on. And so looking over, at the implied deviation level, a one move down from yesterday's close on the S&P would have put us right at 1401. And I'll just go ahead and, we'll get a few charts ready. And then we'll maximize into one of them there. And we'll pull them up step by step. And I'll cover each one of those for about over a dozen markets for you when we get right back from this commercial break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Tom O'Brien's daily trading newsletter, Market Insights, has delivered powerful results for subscribers, and now is the perfect time to try it out for 2 weeks absolutely free. We're so confident in the value Tom provides his subscribers in his daily newsletter that through Labor Day weekend only, when you sign up for a 2-week free trial to Market Insights, we'll send you a free copy of Tom's best-selling book, The Art of Timing the Trade, your ultimate trading mastery system, completely free of charge. Will even cover the shipping cost. Cancel at any time during your 2-week free trial to Market Insights and pay nothing, and keep Tom's free book as a gift from us. This offer is only valid for new subscribers. We've only extended this offer once before, and it will only be active for a short period of 2 weeks. So act now to take advantage of this great offer and be ready to capitalize on a more active, more volatile market once traders return from their August vacations. All the details are on the front page of TFNN.com. Sign up for your free trial to get your free copy of Tom's best-selling book today. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, folks, welcome back to the Diagnostic Trading Hour here. And I was going to scroll through and look at some of the markets for you, sort of see where they've been, where they're going. And we got the S&P, the deviation level. Again, this is a half implied, not a standard, but implied deviation level. Looks like a move down to about 1401.44, and it came pretty close to that, down to 1403. If we back up a little bit, we can see some more on both sides there. And what we'll see is that the market basically just moved down, and really hit its low the other night, 1403. And if we go in and we look at, a move back up, what should we expect on that? And so if we added a half deviation in, okay, so this is, again, how the implied deviations work. So when you're looking for bounces, how much of a bounce up should you expect? And so if I'm using a half deviation, I want to use a half move back up. So if I go over here and, basically like right around, 1403.25, and then I go ahead and add in basically 6.5 points, then I get a move up to about 1409.75. So a full deviation would be 14. So, going in and, not quite 14, but rounding off there. And so, anyway, it's getting really close, 1410 or so. You see it shot up, and that's really where it, leveled out at. And then it, came back down, went back up to that area, and then leveled back down. So, definitely served as a resistance level. It was also the high of the overnight session where it stopped at. So, that helps you with those target levels. And then we go over and we check out a couple of the other markets on the day here. We got the Russell. And on the Russell, the move there, pretty small overall. But if we look at the move, up and down, move up to the half deviation move, on the upside. Full deviation would put us up at 18.18, so it almost accomplished a full deviation move there. But if I go in and add in and I make it a half deviation move, I go, okay, well, what level would that have been? And that sort of helps me get, again, good profit target levels, good take profit levels. And that would have put me right at 8.14. And look at that, right on the money, 8.14. So basically we're moving at half volatility today, okay? And if we go to the downside, that'll put me down to about 8.04. And overnight we got down to about 8.06. And so, we put those together, and that becomes, the numbers that you're able to use. And, a full or a half deviation, would basically would have been back up to where it went up to. And, but yeah, that definitely determined a pretty solid high on the half deviation level for the day. And just being a half trade day there, right? So, and then we go in and we can check out the NASDAQ and sort of see where those levels are sitting at. And, it went down, it went up, and where did it land? And it actually, let's see here, if we look at it, the NASDAQ, the E-mini NASDAQ futures, let me see, did a pull up to 28.11 here, and that would be the full standard deviation move. And, of course, we didn't have a full standard deviation move, but, we did have some pretty good moves right here from the close. It basically, you had some nice spikes there early in the morning on the opening, but nothing, to write home about. And down to 27.68 would have been the low. We got to about 27.70. So literally just within a couple points of that. And again, when you're within about 80% of a deviation level, that's where you're wanting to start tightening your stops, because you could easily be giving back your profits really fast. Okay? So always make sure that you're using that statistical part. We talked about the fundamentals earlier. Okay? Now we're talking about the statistics. And this is all about diagnostic trading. I'm putting together fundamentals and statistics, seasonals, and technicals to figure out where the orders are. All right? So with all that combined, you want to know where the orders are going to be. You want to pay attention to this. And we'll be talking about a seasonal wrap-up here right at the end of the show, one that you need to be aware of the cycle that's coming up right here at the end of the week. So we had that one down there on the NASDAQ, and it did a pull up, and it had a, let's see, a point move there of 28 would have been an actual full deviation retracement, and that would have been a move up to 98. We didn't quite get that. A half deviation would have been about 14 points, and that would have been at about 84. So if we look at, what happened when it hit this low, there's 84, and check out how it's like just hanging out right at that deviation, pulls back down, goes back up, and pulls back down. And and right now we're at 27.84 off the low. So that would have been your profit target if you were reversing. If you decided to go long, you'd be like right in this area, and this is, you'd pretty much call it quits for the day on a long trade at this point, or at least be tightening your stop if you weren't already out. And then hopping over and let's check out the Dow and see where the Dow sits at. So on the Dow, if we got a move down on the Dow, then what we can see is, let's see here, I'll pull it right on up and give you the numbers on that. On the Dow, what we get is a move down to 13.049. We got to move down to 13.062. So, not too far off, about 11 points off, which, obviously, since it isn't whole numbers, is a pretty small move. So we got it right there on the money. And then move up on the Dow would be about 115, would be a full standard deviation move. And, if we look at a half standard deviation move, about, 50, 60 points or 55 points, then that'd put us right up around 1410. Let's see, 13.110. And so we go up here, let's look at what happened, and, went up. It did actually pass this a little bit further, so it didn't go all the way to a full standard deviation level. But it did shoot up, and then it's hesitated out, and now it's actually at 13.110. It's at a one standard deviation level off the low at this very moment. And then we go in and we can check out. Now let's check out some of the currencies, right? Or let's actually check out the commodities first. So go to the commodities and see where they're sitting at. And the commodities, a couple of them moving quite a bit, but I moved down to 3.41. So we didn't even get that half standard deviation. So copper's been pretty quiet. Expect a lot of announcements on copper. If you want to know when copper's going to move, all right, here's a secret. When home sales reports come out. Just think about it. They use a lot of copper when they build homes, okay? So that's a big impact on copper. So you're looking at those home sales days and start looking at copper, and that's when you're looking for those standard deviation, big, nice moves in the copper market. And if you are trading copper, trade careful, because it's not the most liquid market in the world, and I highly suggest you check out something like NADEC to trade it. So that way you can, limit your risk, maximize your leverage, and help you be a step ahead. And because copper can, it makes and loses money really fast. And so you want to be able to have something that can help you create the protection on the loss side with the potential for the upside. And to get one, just hop over to tfnn.com. If you don't know, get tfnn.com, and then click on Nadex, click on Create an Account, and you can click on Start to Open Account. So $100 to start trading on Nadex, $100 deposit. And live data feed, broker, not really broker, live data feed platform, everything built in with no commissions. You only have exchange fees. And you can also open a demo account by clicking Open a Demo Account right there. And so make sure you do that and follow along with us as we do some trades. Throughout the week, we'll do a few trades on Nadex. And so that's copper for you. We can go over it. We can check out gold. And gold right here, let's see, a half deviation move down on gold would have put it down to 1669, and it went past a half deviation level there. And I can even see, did it move a full deviation level? And it went on down to 1662 for a full deviation. So it basically went right down to that full deviation move. Gold was definitely moving, and then it stopped. So I mean, you had a little spike right here, a point or two, but I mean, it basically hit that standard deviation level right on the money, stopped, turned back around, went the other direction. And so that implied deviation is huge for giving you accuracy on where to take profits, where to look for reversal plays. And if we look at a 13-point reversal on that, that puts us up at about 1373. And look at that, we're at 1375, and then it turns back around. So if you're going long, it would have let you know at this point it's time to start tightening your stops. And that would have been very, very useful for you. So again, know your implied deviation levels, know your statistics. They're not as hard as they sound. And we'll be releasing a tool real soon for you to help you out on that too. And then we hop over on silver, and on silver, go in and look at what are the levels on that, just so you know these numbers. So if you're trading right now, if you're going to be trading through the end of the day, it's important to know what these numbers are, so you can use them for the rest of your trading day. And on silver, it puts us down to about 30.95. Let's see here, and on up. So let's see what we got. Yeah, I mean, we're right at 30.95. We actually went a little bit further down than that this morning. So. Let's see, 30.90. Actually, 30.90 would have been a half standard deviation, a full deviation. So the metals being the movers today right here. We go in, and I can let you know the exact full standard deviation move would have been down to 30.75, and it even broke that level a little bit. So, but it went right down about here, and then closed, and then dropped, and then it's moving on back up. And then if we go over and look at our crude oil and our natural gas. So y'all know I like to be trading crude oil quite a bit over on Nadex. And one, crude oil is a choppy thing, and it moves fast. And I don't like that unprotected level of trading oil just out on the open futures market. I'd rather trade and mirror the market using the spreads. And I mean, just look at some of these drops that happen literally in a matter of minutes. This, literally, I mean, you're talking several $1,000s in minutes. And so on oil, what we're looking at is, let's see here, we got a close yesterday about $95 there. And on the market, and if we look at what it's moved at so far, a move up to 96.36 would have been a half standard deviation level on up. And boom, to the penny right there. So moved right on up, came down, tried to test it, moved down, came back up, came down, tried to test it again, came back down, moved up. So, I mean, that's literally the standardization. I mean, don't talk about swing trading. You like to swing trade? There you go. So just right off that implied deviation level, and just playing that over and over and over again. And then if we go in and look at a couple other things here, we'll come back to this oil trade. We might find something there we like. And we can go in and check out the natural gas. So, and natural gas has been a big mover lately. Just, look at these, I mean, massive moves, big drops, big drop again, dropping and popping back up again today. And over on natural gas, we can see is a half move would be down to 2.62. It definitely hit that. A full move would be all the way down to, let's see, 2.57. Didn't quite get that low, but it definitely hit that 2.62. And that's about right there. And basically just, hung out for a little bit and then flew on back up and basically retraced a full deviation level on that. And we can go over and check out, of course, our ags have been hot topics recently. And so obviously this hurricane is going to, there's a lot of bad things about the hurricane, and it'll definitely send the light out for everybody out there. And Louisiana and Alabama, and I mean, they're going to get a lot that's starting to come in right now. And it's also going to bring, of course, a lot of rain across the country. But not the way that you want it, right? So just, praying for those people and helping them out. And right now it's Category 1. And hopefully it doesn't, get any, stronger. And hopefully there's some wisdom out there with the government officials, and they're able to really help a lot of people and give people a safety in the process. And looking over here at corn, then we can see that we have some moves down to, let's see, about right there, 7.95. So we're getting a small move there on corn, and not a big deal. But the big mover is definitely looking over at the soybeans. And the soybeans, I mean, if you just look at this, I mean, it came in, it closed out. I mean, you're just getting massive drops. You're talking 20 points. I mean, that's $1,000, okay? And down and up. So there's a lot to be made in soybeans, but soybeans are scary to trade. Corn is scary to trade, but it's not scary to trade if you're trading on Nadex. And so what I'm going to do here is I'm going to pull up Nadex and just show you some things so you can just sort of see how it works and how it looks. And a quick wrap up for you too on the currencies. If we're looking over at Euro USD, we can see that it is popping, dropping, and moving all around here. Looks like on the Euro, I mean, it closed out, dropped down, and it's flying back up. So there's a lot moving on the Euro there, and basically Draghi's not talking. Great, go over rallies. And so sort of interesting, sort of the opposite. Bernanke's talking, and then boom, market rallies. So Bernanke talks, it rallies. Draghi talks, it goes down, because he usually didn't have anything real of substance to say, unless he's saying, I promise we'll do everything, and then he does nothing. And I think that's the big reason he canceled it too. Nobody wants to hear what they're talking about doing. They want to hear what they're doing. But just doing a quick wrap up for you, looking over at the franc there. Franc is dollar definitely gaining some strength there against the franc. And I'm sorry, the dollar losing against the franc, and franc getting more and more and more. And be careful on that, because man, that the Swiss government, they will intervene. They have proven it, and they will do it. And you can see right here, they just popped it right up. But we'll go ahead and move on back down, and we check out one last currency pair. We'll go ahead and look at the yen. And the yen basically went right down to its deviation level, 78.57. It came, literally hit it, dropped a few more ticks, and then came back up. So it gave you a great target if you were riding this short down this morning at all. And so I hope you're starting to pick up a little bit of how the deviation levels work, how you can use them to set profit targets. And, of course, we're always going to be going into more on that, and I'll be giving you tools to help you out with that as well. So now let's check out Nadex, and let's see what we can set up here before the show's over, just as a good test trade, okay? And we'll probably be focusing here on oil and what we can do on that. And we may even look at a couple other setups, but probably looking over at oil. And when you log into Nadex, here's what you're going to see right here. You're going to log in, and platform's going to come up. When the platform comes up, you can go in and you can choose whatever you want to trade, such as commodities, all right, spreads, or binaries. And we'll take a look at both. And then we go into crude oil. Okay, we can even do the same thing down here on the binaries. We can look at crude oil. And so if we pull up oil, and we see what it's done for the day, and it keeps, just bouncing off this level all morning long, over and over and over again. So you can see it hit it there, and then there, and then there, and just keeps moving off of it. And let's say you want to do possibly a fade play on oil, okay? Or if you want to go long. Either direction you want to go right now, what are some plays that you can do? And so first thing is we need to know the price of oil, 96.30 basically, give or take, right? So if we go into oil and we check that out, then what we'll see right here is you got the spreads and the binaries. I'm going to pull them up, and we're going to do a quick wrap up right after this commercial break on a potential oil trade setup for you.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of of shorting and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to check out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday, Wednesday, and Friday, 11 a.m. Eastern, on TFNN.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the Rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, folks, this is Darrell Martin here with the Diagnostic Trading Hour. So we got a caller. We got Keith from Hawaii. How's it going, Keith?
Hey, I'm doing okay, Darrell. Thanks.
Oh, yeah.
I got kind of confused. Where do you get these? You were talking about, I think, on the E-mini, you were talking about a standard deviation, a half a standard deviation. Was that right?
Exactly. Yeah, what you do is you take it's an implied deviation, a little bit different, but you take whatever the implied deviation level is, okay, and you just right in the middle of that. So, for instance, if you're looking to say at the S&P E-minis, then if you go in and you look at what the really the difference is between the two, so if the market closed at 1408 yesterday, all right,
okay,
and one implied deviation is at 1394.5, all right, so
wait, how did you get that? I'm missing the connection there. 1408 and 1394.5.
Okay, the 1408 is that's the closing price of yesterday.
Okay.
Okay, and then the implied deviation is one implied deviation on the S&P E-mini futures for today is 13.75 points. All right?
Okay, how did you get 13.75 points?
I go through a really complicated formula.
So I get you. Okay.
And we're putting an entire tool up that's doing all that for you. So
okay, so you subtract the 13.75 from the 14.08.
Exactly. So if we do 1408.25 there, and then we bring up 1408.25, minus, exactly like you said, minus the 13.75. That puts us down at 1394.5. And if I want to take the difference of that, okay, but where I really, the easiest way is just take the deviation level, divided by 2, all right? And then go over and go, okay, so half of an implied deviation level would be 1408.25 minus 6.875. And so that's where I get the half deviation level.
And then the market could, so that puts the market down at 1408 minus that half.
Uh-huh.
So would that be the bottom, would that be the bottom support, and then it would range above 1408 plus the 6.875?
Yeah, so basically, that basically is the point where you want to tighten your stops, okay? At half level, even on a standard deviation day or, full deviation day, I'm still looking to usually start tightening my stops around half a deviation. But I'm really looking to probably start taking a majority of my profits at a full deviation level. So if you weren't already out, and let's say, looking at the S&P, and it's getting down there, obviously it's, moving down. And so as we're getting closer and closer to that level, I'm going to want to start tightening my stops.
I see.
And because, we get down, we're only like, a point or two away from hitting the mark. Well, and all of a sudden I start seeing this action right here where you start in the same highs, same lows, over and over again. Then the market's getting really choppy. I don't have a lot of confidence in that. I don't want to give back my profit. And so it's really important to have, some profit goals and some areas where you're like, what, if it starts reversing past this, I want to get out. And, just so I'd rather, keep some and lose, all my profit. And one of the worst things as a trader, of course, is making money and then giving it all back. And to do a wrap-up, too, to show you here on oil, like what we're doing. Let me see here. I'll pull this up and I'll let you see the oil trade. And go over that real quick before we wrap up. We got oil right here. It's just been hitting this level over and over and over again. So one of the plays I did is I went and I got short on the oil spread. Goes from 96 all the way down there. And if I'm looking at that oil spread, I can show you the trade I put on during the break there. We were looking at going short. And I went short at 95.90. And there's two different spreads you could look at. But the reason I went short at 95.90 right there is so that way I can make money all the way down, all right, to 91 on the trade that I did. But I can only lose $100, which is only a 10-cent move against me in oil. So the reason I use Nadex on these implied deviation reversal levels is because I don't want to catch a falling knife, So, or, if the market's taken off, I don't want to fade it without having something like Nadex to help me catch that. But it's definitely a reversal play as well as a take profit play. Thanks for calling in, Keith, and I look forward to talking to you soon.
Okay, thank you. Bye-bye.
Hey, you bet, man. Thank you. Have a great day, and I will see you tomorrow.